Okay, we are at an exciting juncture. We are at the corporate bond episode. So, time to get started and understand what that whole world is all about. My usual disclaimers: this is not investment advice. I intend to educate you. You make the decisions. And I am not a wealth management advisor, and I have nothing to sell you other than sharing what I have acquired in terms of research over the times. All right, here is generally what we'll be covering. The structure is going to be very similar to some of the other income producing assets. We're going to be talking about what the product itself is about, what are corporate bonds, why did they come to be, how can you understand them, and so on. And then we'll go on to the yield curve, we'll talk about the current rates, and then we're going to overlay corporate bonds on top of all the other income producing assets and understand when it makes sense, when it does not. I would absolutely suggest to you that if you have not listened to the work on treasuries and then agency bonds and then municipal bonds, you need to do that before you come to this episode because we are going to build on all of that as we proceed. All right. Welcome to Yield Nerd, an educational show about how you can acquire and manage yield, right? So let's step back and ask a more macroeconomic question. If a company needs to grow, how is it going to find capital? And in reality, there are three ways a company can generate cash. One is what we call working capital. They buy things for $1, they sell it for $1.20. That extra 20 cents, when they put it in their bank, generates that free cash flow, as it is called. And some of it is used to pay salaries and pay utilities and rent and all of this stuff. Maybe 7 cents, 8 cents, whatever the appropriate profit margin is for that industry is left. And as they accumulate that margin over a period of time, they can then use that to invest in growth. So that is one way for them to get cash. The second way is they can issue new stock, or they can go public, or they can raise venture money, or whatever it may be, they can sell a percentage of the company to raise cash. The third method is they can raise debt. They can say, hey, I don't want to give you a piece of the company because we want to retain control. We want to be the majority owners. We want to keep the ownership structure as is. But if you would give me money, then I will pay you back. And this is the tomato form, if you will. And we will be spending time understanding the corporate version of the tomato farm or the bond side of the house. And so it is the one of the key methods in which companies generate cash, and arguably many times the size of the equity market. And you will see what I mean by that as we go further. One quick thing, I found a research library in this topic that I found extraordinarily informative. So I'm going to walk you through a series of their charts. I want to make sure I cite them properly. You are welcome to Google it and read the 100-ish pages there. This is called The Future of Corporate Governance in Capital Markets Following the COVID-19 Crisis. It's a fantastic reading, and here are the general snippets. If you look at the global equity and debt trends, the first thing that becomes clear, and as I said, as you go through this, you will understand liability or debt is even bigger than equity. And so when you look at the balance sheet of companies across the entire world, the liability side of the balance sheet is now much bigger than equity. And within liability, the biggest chunk of liability is debt. Now, there are other kinds of liabilities like accounts payable, trade payable, and all those are other classes of liabilities. But what you really want to understand is that debt, which is the instrument we're going to be looking at, is the biggest chunk of liabilities, and it also is growing over time. So companies are getting more comfortable borrowing and using that as a cash flow as opposed to using equity. And working capital is something that is scarce in an early stage company, and in some cases even in mature companies. And so they use debt as a way to undertake major projects. A couple of other things globally. sales is growing as a percentage in trillions. But if you remember what you saw a moment ago in terms of how fast liabilities are growing, unfortunately, sales are not growing as fast as liabilities, and profits aren't really roaring ahead. So if you can step back just from those four data points, debt is increasing, sales are increasing but not as fast, profits are, kind of sort of there. What does that tell you? A lot of the borrowing is financing companies that are growing slower and not as profitable. You tell me what that means. So now if you said, you know what we're going to do, we're going to take companies that are highly profitable. And if these ratios called return on assets and return on equity are foreign to you, you need to go back and find the episode that reviews the basic terminologies in financials. And I do not remember the unit, and I'll try to post a link here so you can go back there. But effectively, what this is saying is how much return is a dollar in asset producing? And unfortunately, again, in aggregate, what used to be a phenomenal ratio was 16%. This is the high profit companies that are not in the financial industry. And unfortunately, instead of almost a sixth of the companies being in that high profit, now it is barely a tenth of the companies that are in that area. The same for return on equity. And again, you can Google what that means, but effectively, what it is saying is the share of highly profitable companies in the world is dropping precipitously in the last 15 years, while at the same time, their debt load increasing. And those two go hand in hand, because in order to service debt, you have to pay interest. And as you pay interest, your profit goes down. And so the number of stellar companies that are generating tons of cash, don't have a lot of debt, they're able to service their debt and grow faster, those are becoming fewer over time, unfortunately. The next thing is what we call leverage. Leverage is how much jacked up on debt are you? Meaning, if I took your total debt and divided it by your assets, what kind of a number am I going to get? So if I had $100,000 in assets and 5,000 in debt, that means I have a 5% leverage. As you can see over time, the aggregate leverage is increasing, and the median leverage, which means half the companies now have almost 20% of their assets in debt. That's a statistic that you just need to think through. Half the companies have 20% of their assets in debt. And when you look at the companies that have very little debt, 0 to 10% debt, that kind of is going down over time. What is becoming a bigger and bigger portion is companies with 20 to 50% of their assets in debt. So the aggregate observation I would like for you to make is that the median leverage, it's not uncommon for a company to have more debt now than before. And if you then say, okay, if you have debt of $1, how much profit do you make? How does your EBITDA, as it is called, compare to debt? Well, there is a big variation here, and many of you who have invested before will know that utility companies tend to have a lot of leverage because it takes a lot of money to start a power company, and you have to put the plant and you have to get the generator. And so utility companies are 35%-ish leveraged. And if you look at their profit, their debt to EBITDA, according to this data, those companies, the debt is a high percent of their EBITDA. What that means is a lot of their profit goes towards servicing the debt. And what is very interesting to me are a couple of data points here. Technology companies do not have a lot of leverage, and they also have a good amount of profit that a much lower amount of their debt is serviced, meaning their profit is much higher, that when it comes to the comparison between debt to EBITDA is a much shorter ratio. So if you look at this, you kind of want to be at the last few rows of this table. And what this is saying is energy companies don't have a lot of leverage and they make a lot of profits. Technology companies, similar situation. And then some of the other stuff or the other way around. Telecom companies have a lot of leverage. However, they appear to make a lot of profit that they can afford that leverage. And that is what this is saying. So to kind of keep continuing on, if you have a lot of debt and the industry has a lot of debt, then what happens in terms of insolvency? And the reason we are reviewing insolvency is when you are a bondholder, you are lending to the company, so you need to understand insolvency. And if you look at the non-investment grade, to be clear, this is not investment grade, it's non-investment grade. What this is showing is over a period of time, insolvency rates have gone up and down, and off late it is creeping up. Not only is it creeping up, when companies go insolvent, the number of cents on the dollar that bondholders are able to recover is unfortunately going down. That's what's a double whammy. Not only are more companies going bankrupt in down cycles, the recovery rate of cents on the dollar to bondholders is also going down. And there is a very clear explanation to that. And if you want to email me or you want to read that OECD paper, we can do that. In the interest of keeping us moving along, we'll just say that is indeed the scenario in non-investment grades. And we're going to look at investment grade bonds in a second, but in non-investment, there is a double whammy in that insolvency rate increases and recovery rate decreases at the same time. So then we're going to say, gee, I wonder how investment and non-investment grades compare, because we're going to start with looking at investment grades. And these are denoted by these numbers. AAA means the highest credit worthy companies, and then AA and A. And as you can tell by the direction of these curves, the highest of the high credit worthy companies as a percentage of the total are dropping. Then you have to ask the question, well, if the highest companies are dropping, what is going up? And so the double A's are becoming a single A, the triple A's are becoming a double A, and all of these are purely because leverage as a whole is increasing. And this is interesting. Triple B's are decreasing. And you have to ask the question, gee, if investment grade triple B's are decreasing, what is happening to them? And the answer is on the right hand side. They are going from becoming investment grade to non-investment grade. And non-investment grade is a fancy name for a much cruder term called high yield or junk bonds. So what this is saying is some companies, as their creditworthiness decrease, they slide from investment grade into non-investment grade, and that kind of has its own dynamic in the long run. So then the question is, who holds these bonds, both domestically and internationally? In the United States, for example, Americans own American debt, which is wonderful. And then you look at within the debt holders, who holds it? The top three largest debt holders, and you can Google who they are, they own the majority of the debt. So if you Google biggest bond holders, you will see who they are. And so what this is saying is that there is a very heavy concentration in institutional bond owners. And what does that mean? We'll talk about that as we proceed as well. So let's dive a little bit deeper into recovery rates. And when it comes to recovery rate, pardon me, when it comes to recovery rate, if the bank is the one that is giving the loan, whether the company is distressed, which means they're having trouble paying, or bankruptcy, which means they just have no capacity to pay, the bank is able to recover quite a bit because the bank will always take as collateral something they can use. Once you go beyond bank debt, then you get into senior debt and then subordinate debt. And as you can see, as your risk class goes lower, then your recovery rates are going to go down. And if there is a redefault, meaning if there is a second time default, you can see how things get absolutely crushed in bankruptcy. What does it mean to you as an individual investor? Your responsibility of doing financial due diligence is very high. You cannot just go by the credit rating and say someone else thought it's AA or it's triple B and I'm good with it. You should learn a little bit more about it, and we'll talk about what that means as we go along. All of those statistics are from the OECD, and now I am going to go into the next part of why do we need corporate bonds at all? Where are we, and where do we go from here? Thank you for your time. We'll pick it up in the next part. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.